Bilal Hafeez, Macro Hive founder and editor, joining me now on set. Nice to see you. So a hot number. We were just talking to Jeff Lacker, formerly of the Fed. He says it's a situation where the Fed is going to have to react more strongly than originally anticipated. He says 50 basis points in March is a good call. What do you think?
I think I'd agree with him on this in this instance. I think 50 basis points is definitely on the card. There's probably another 4 hikes after that as well. And this just tells us that
this year,
indeed, right. Yeah, this year. I think this number just tells us that inflation, at least in Q1, is still very, very sticky. And on top of that, there's a lot of political pressure as well for the Fed to be seen to be doing something as well. And so I think 50 is a very plausible case now.
Well, does this set off the rate hike essentially heard around the world, this rate hike that we're expecting in March? And what are you looking for? 25 basis points, 50 basis points? Should those bets on that 50 basis point hike be taken seriously?
For the US, for the Fed, yes, I think it should be taken seriously. The risk return for the Fed is that, in this current environment where inflation is relatively elevated, this is their chance to establish some credibility and start off with a 50 basis point hike. Then they can moderate afterwards, but this sends a clear signal of intent. The one risk for them is if they do start with 50, then the market might start to price 50s for every single meeting thereafter. And so they're going to have to, try to manage expectations around the fact that the subsequent hikes may not be 50.
The curve is very flat. The action today in the 2-year, we got nearly up to 2% on a 10-year, but nevertheless, the curve continues to flat. We're kind of circa 50 basis points now. What signal does that send? Is that sending a signal that the Fed is going to make a policy mistake, that we are going to see a significant growth slowdown, and that this is something that we need to all start to prepare for? And actually, that's where the biggest shock could come from.
I do think that's indeed the case. I mean, I think the curve flattening is interesting for 2 reasons. One is it tells us that the markets, at least, don't think inflation is permanent. So rates markets are telling us that inflation is transitory, and that's an important element of this all. But also it's telling us that there are significant downside growth risks. And I think there's a significant chance of a recession even towards the end of this year. And that's what the rates market is telling us.
Well, is the rates market on par with what the other markets are telling us, the stock market, specifically the oil market? You're seeing calls for $100 oil, $125 oil. Is the bond market really taking that into account?
Yeah, no, that's a good question. I mean, I think there's lots of cross currents here, but what the oil market's telling us is that there's a supply issue on the oil side. There's been chronic underinvestment in oil, and to some extent, we're still seeing the after effects of the negative oil price that we saw after COVID. So to some extent, there's an unwind of that. There's a supply issue that is leading to higher oil prices. But also, if the global economy is reopening, to some extent, oil prices will be higher. At the same time, though, if you look at previous recessions in the US and elsewhere in the world, almost all of them occur when you have oil price shocks, and that's the zone we're in right now. Oil prices are almost 100% higher than they were a year or so ago. So, so the message from oil prices are, on the one hand, there is some kind of recovery, but it could largely be due to supply. And also on a forward-looking basis, higher oil prices often precede or lead to recessions.
What does this mean for the ECB? We've seen, obviously, the ECB belatedly having to play a little bit of catch-up. We don't know ultimately what that's going to mean in terms of a shift in policy, but there is going to be a shift in policy. We're seeing BTP yields starting to rise. They've accelerated again to the upside. If the Fed goes 50, what is the ripple effect?
Well, I think one ripple effect is the market will start to force the ECB's hand and try to get higher market pricing for the ECB. The ECB, though, is in a tricky situation because a larger component of inflation in the Eurozone is driven by energy prices, whereas in the US, there's other parts of the inflation basket that are driving the inflation pressures that we have there. So the ECB is kind of stuck in the situation where they're deciding whether to fade the inflation energy shock or not. At this stage, they want to open up the possibility of a hike, but I don't think they necessarily want to do anything too dramatic. On top of that, they also are constrained by the sequencing, where they have said that they're going to do QE, they'll do APP, they'll reduce the APP program, and then do a hike. And that really reduces the chances for them to do dramatic hikes this year.
So you talked about the ripple effect for the 50 basis point hike. Can you talk about the ripple effect for, say, the ECB, the BOJ, the BOE, for central banks around the world that perhaps might be taking the Fed's cue?
Well, I think for other central banks, it varies region to region. Certainly, to some extent, what's happened to the Fed is to some extent the script that other central banks will have to follow at some point, where initially they discount inflation, then later they have to pivot. Now, there are some central banks who are pushing back. So the Bank of Japan is quite significantly pushing back. Earlier today, they announced almost infinite sort of purchases of JGBs to keep 10-year yields lower, and they've been very adamant that they won't raise rates. And on top of that, Japan doesn't really have an inflation problem in the first place. The real swing variable here is more for the European central banks, so the ECB, the Bank of England, where the Fed hiking sort of cycle will really force them to be more aggressive as well.
Let's continue the ripple around the world and ripple into other asset classes.
Sure.
What does this mean for equities? If the Fed went 50, do you think equity markets how would equity markets react? I'm really surprised today. We've seen an above expected print on inflation. Equity markets initially dipped, but then the buyers have come back in really quite quickly. Is that a narrative that we can continue to repeat? There was this idea that we're going to pivot from buy the dip to sell the rip. How embedded is that?
Yeah, I mean, I think this year is going to be a tough year for equities. I mean, my overall sense is that we're likely to go sideways in equities. We'll have some, weeks where it goes up, some weeks where it goes down. But the overall conditions are such that, Fed tightening overall will be bad for equity markets. All this liquidity that was injected in the world after COVID went to equities, especially U.S. equities. As that unwinds, that's going to be bad for equities overall. The one caveat I would add, and I think one reason perhaps why risk markets have bounced a bit today, even though we've had this inflation surprise, is that if you look at the details of the inflation numbers, it's still the case that most of the inflation is really in the goods sector. It's not really significantly in the service sector. So I think, equity markets to some extent perhaps could be saying actually this means that the Fed won't necessarily be hiking too aggressively. So the terminal rate won't be too high, which in the end may be positive for stocks.
So positive for stocks perhaps in the long term, but I'm curious, you talked about all of these kind of flows really concentrated in the U.S. equity market. Does this mark the moment where you start to see the U.S. underperform the rest of the world?
Yeah, I mean, I do think that will be the case. We've seen significant underperformance of the rest of the world relative to the U.S. There's been all these flows into the U.S. away from the rest of the world. And I do think that we're in this environment now where, for a number of reasons, the rest of the world should outperform the U.S. Number one, the U.S. front-loaded all of its fiscal stimulus to last year and the year before, whereas other parts of the world, especially Europe, spread out its fiscal stimulus. On top of that, Europe and many emerging market countries have been more affected by Omicron and the COVID pandemic than the US has in terms of restrictions that they've implemented. So as we start to see Omicron become more endemic, then we'll see those countries see a stronger reopening benefit. And then finally, if you look at sectors like financials, higher interest rates will benefit financials, and the rest of the world stocks are more geared towards financials, and so that should be something that should provide support for foreign markets.
What's the price action in Bitcoin telling you right now? 45,000. I think a lot of people thought that it would be crashing significantly lower than this in the current environment, particularly as tech gets hit on the back of rising rates, the long duration story, yet it's holding up. Thoughts?
Yeah, I mean, I think there's a couple of reasons why it's holding up. One is that there's still a lot of institutional demand for crypto. And so all the conversations I have with so many different types of players, you're finding lots of, crypto specialists wanting to pile in more, and also non-crypto specialists wanting to come into that market. So there's a big kind of queue of funds still trying to get access to this new asset class. The other thing I would say is that if you look at some of the on-chain analytics and the flow dynamics within crypto markets, what you are seeing is that there's still a very high level of confidence in crypto. So whether you look at the flows into ways of holding crypto or Bitcoin that's illiquid, that's actually increased of late. So that means that crypto sort of specialists have a lot of confidence in the crypto markets. Then on top of that, you have to remember that Bitcoin, for example, has had a 50% drawdown since since late last year. Equities haven't. That's a very large drawdown. And so in this context, there's a lot of people are coming in to kind of sort of value buy Bitcoin, if there is such a thing.
Buy the dip.
Yeah.
There's some really impressive performance here from the European banking sector. It has been a perennial underperformer. I forget the last time we saw decent performances coming out of the European banking sector when book values were well north of 1. Talk to me about how much is left in the tank.
I think there's a lot of upside still left in the tank for a number of reasons. One, and perhaps the biggest, is the fact that yields are going up. There's an incredibly strong relationship between the relative performance of banks to European yields. So if you look at banks to the overall index ratio and say the 5-year yield or 2s, 5s, the steepness of the curve, it moves almost in lockstep with each other. So high yields, steeper curves is great for banks. But on top of that, what you're also seeing is that the dividend story and the buyback story for European banks is very positive. So the dividend yield, the gap with the index is very, very high. Then also, somewhat strangely, even though we have negative rates in the Eurozone, deposit growth has been very, very strong too. So European banks have a really strong funding basis. They're funded through deposits rather than wholesale markets. And so as the economy recovers, we should expect loan growth to pick up. And balance sheets and NPLs and so on are reported to be relatively low as well. So there's a lot of operational leverage that we're likely to see as the cycle turns. So overall, I think it's a very positive story. I think this year is likely to be a breakout and continued breakout story for European banks.
Well, talk to us a little bit about how much that breakout or how much that success really rests on what the ECB says, essentially on the words of Madame Lagarde. What are your thoughts?
I think there definitely is a big component of what she says. At the same time, though, global yields are going up. So even if the ECB was to turn a bit more dovish, what we are seeing is that 5-year, 10-year yields are being dragged higher by the fact that the Fed is raising rates and global yields are going up. So one is, it's not entirely dependent on the ECB. Where it does, where there is some uncertainty around the ECB is related to the TLTROs. And so as the Fed starts to wind down its QE program, starts to wind down some of the TLTROs, which has provided really good funding for European banks. The question is, how much of European banks really benefited from those TLTROs to sort of juice up their profits? And so that's some risk that we do have, around the ECB policy. So it's not entirely a function of the ECB being hawkish.
We still haven't fixed the relationship between the European bond market and the banks. Now, right now, that feels positive. But if we were to see, for instance, Italy or another peripheral country having a problem and debt levels are very high, does that risk come back onto the table? Or have we at least sort of anesthetized that risk for the time being, given the backdrop sort of elsewhere? I'm just like, is the doom loop done, or is this something that we need to worry about once more?
I mean, I think in the short term, we could see a doom loop. So if we do see Italian spreads blow out, then there could be, in the very short term, an impact on European banks or Italian banks. But I think it's very clear that the ECB would step in no matter what to prevent the doom loop. And it's if you look at the ECB's reaction after COVID, where they initially said they didn't care about yields, and then Italian bond yields started to sort of shoot higher, then they immediately pivoted. It tells you have this put option from the ECB that will always be there to prevent the doom loop from really escalating.
Yeah, just not fixing it, just preventing it from escalating. Bilal, great stuff as ever. Thank you very much indeed for dropping by. Bilal Hafeez, Macro Hive founder and CEO. This is Bloomberg.